We finally snapped the 5-day losing streak here in the United States with a bounce back rally today, which was good for about 0.8%. So not a huge rally, but nonetheless kind of stopped the losses for the time being, and did so at an important place right on the top side of a rising 30-day moving average. So it gives the bulls a little bit of hope as we head towards the weekend here. However, we did see a number of posture shifts back to bearish despite today's activity. So we'll go through all of that in tonight's video. We'll of course get through some macro analysis. I wanted to talk about oil prices in particular and some of the damage that's been done in that area here recently. And then I wanted to get into the trade application example, which also features a trade within the oil and gas stock world. This one will be a bearish trade as many of those stocks have started to get a little bit more wobbly here lately. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's December 8th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. We're also heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee, and we really appreciate those of you that click like and retweet with these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join us at that web address in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, we had nice green patches of grass all over the place here. Much more healthy view of the market than what we've seen in the prior 5 days. We finally snapped our 5-day losing streak and had some nice wins here and there. It's been a busy afternoon as well. For those of you that follow me on Twitter, you'll know that I've been busy tweeting about what feels like an endless amount of dividend increases here this afternoon. So not only were the markets bullish here today, but we are just getting a whole slew of dividend increase announcements here after hours. So if you need the details on that, feel free to check out my Twitter timeline there. But stocks like Bristol Myers Squibb and Broadcom and Waste Management and Edison International, Ecolab, Zoetis, just seems like they're coming in fast and furious here this afternoon for whatever reason. In addition to that, we also have some big earnings announcements coming out from different retailers and things like that. And surprisingly, I noticed that 3 of the stocks that are reporting earnings just so happen to be 3 of what we call our coffee can positions in my top-down trend trading class. That class, as the name suggests, is where we trend trade. It's not an investing class. But what we're hoping to do is to stay in trends for long periods of time, such as, let's say, 3, 4, 5, 6 months, something like that. So it's a longer form of a trade as opposed to a shorter term swing trade. But anyway, once one of our stocks in that particular trend trading class goes up by more than 100%, we sell half of our shares, extract our original cost basis out of that situation, and then play with the house's money with the rest, and then we kind of put those into a separate part of our class portfolio, and we refer to those as our coffee can positions with the hope that they will stay there and work for us at some point in the future. But anyway, it just so happens that 3 of our coffee can positions all reported earnings after hours here tonight. DocuSign, Chewy, and Lululemon. DocuSign is up a whole bunch. At last I checked, it was up like 10%. That's being somewhat offset by the, I believe it's a 7% drawdown in Lululemon, and then Chewy is basically flat. So basically we've got 1 up, 1 down, and 1 flat, kind of evens everything out there. But just by pure coincidence, 3 out of our, whatever it is, 8 or 9 coffee can stocks are reporting earnings this afternoon. So we'll see how the market treats them first thing in the morning. But point being, there's been a lot of activity here all of a sudden on what has traditionally been a quieter month of December. So make sure you're keeping up to date with all that good stuff on my Twitter timeline if it's of interest to you. In terms of what's happening today, as mentioned before, we have a lot of green in front of us, so thankful for that and getting a little bit of a bounce in the markets there. I did want to point out one of the red squares here as well. Activision Blizzard right here kind of in the middle of the screen is down 1.54% today. Some of you may recall that we actually have a bull put spread on that trade going right now, and wanted to bring them up specifically because they were very much in the news today as well. The FTC came out and sued to block the Microsoft acquisition of Activision. And remember, when I set up that trade example for you that evening, I was very clear that that was happening in terms of the acquisition. And so I wasn't aware when the FTC would come out with their decision, but it came out a little bit sooner than I was anticipating. That was not necessarily a pleasant surprise. However, I will say that as it closed down just 1.5% today, to me, that is a fantastic result, given the headline risk that was associated with that, because there's been other situations in the past where the stock that's about to be acquired runs into some sort of a brick wall, and that stock might collapse 10, 15%, something like that, where the market just truly believes that deal is not going to get done. So the fact that this was only down 1.5% on what is effectively the worst news you could get, I am actually quite pleased with that, and that stock remains above our sold strike in that bull put spread. So feeling reasonably good about that. And I think I heard them mention on CNBC that the CEO of Activision came out and sent out an email to all of his employees saying that they very much think that the deal can still get done. So they'll be appealing that decision and probably taking it to the courts. But anyway, that one was in the news, so I thought I would share that information with you in case you hadn't heard that at all either. Of course, this time of year, holiday season, if any of you have sons or grandsons in your life, I imagine some video game shopping is probably in your future, and Activision Blizzard is the company behind Call of Duty and so many of the other very popular games these days. Another stock in the communications area that was down quite a bit today was Google, and actually that's one of our other coffee can stocks, so it's kind of weird how they are all coming into conversation here today. So Google is another one of those that I had mentioned before with Lululemon and DocuSign and what have you, where we doubled our money in it. But anyway, things haven't been going as well for Google here in recent weeks and months. And interestingly enough, as I was looking through trade ideas here earlier today for this presentation tonight, I almost went with a bearish trade on Google. So that one is kind of starting to break down below its moving averages. I'm a big fan of the company, but like all companies, they can be mispriced on occasion. And perhaps this is a situation where Google was just too richly valued, or perhaps just needs to give back some of those gains that it was allowing shareholders to receive over the years. But today it kind of stood out to me, strangely enough, to the downside, while a lot of the other mega caps did just fine today. As you can see, Apple was up 1.2% today. We saw Microsoft up 1.2% today. We saw Amazon up over 2% today. So it was a little bit strange to see Google kind of fall out of the ranks of those other mega caps. You did see that Tesla fell once again, and that seems like it's an ongoing issue. Tesla is another stock that I've had on my radar for bearish trades here more recently. In fact, we looked at that in one of my classes, even if we haven't had an opportunity to do so in all of these other presentations that I'm doing. But anyway, Tesla still remains kind of in the house of pain, trading well below its falling moving average. A lot of shareholders concerned that Elon Musk is spending a little bit too much time with his shiny new toy of Twitter and not quite spending enough time back at the old Tesla headquarters anymore. So anyway, that one continues to be a struggle as we kind of grind into the year end here. In terms of consistent selling here today, I would categorize energy in that regard, and that will actually be my focus point with the trade application example that I did select here a little bit later tonight in the video, so stay tuned for that. But as you can see in the energy patch down below, Exxon and Chevron did manage to close in the green, but even that was a little bit underwhelming. They both started off guns a-blazing this morning as there was some positive news coming in on Exxon, and they ended up giving back a pretty big portion of today's gains. They still closed in the green, but it was not nearly as good of a day as it started for ExxonMobil. And then as you can see, a lot of the smaller energy players closed firmly in the red. Pioneer looks like it really got hit here today, down about 3.5%. In terms of consistent areas within the green, it's hard to pick and choose there because, more sectors than not did close nicely higher here today. But I would say that technology did impress me here today. You had the vast majority of tech stocks closing in the green, and you can see that one of the biggest semiconductor companies out there, NVIDIA, had a great day, up 6.5%. And there's that Broadcom that I had mentioned before. They were up 2.4% today, and that was before their after-hours information where they're releasing, some business updates and have increased their dividend a pretty nice amount. That's a stock that's kind of been a sneaky strong dividend growth stock over the years, where they've had extremely robust dividend growth and have also contributed lots of capital gains for shareholders, as that's a stock that we've owned a multiple of times in my dividend growth investing classes over the years that maybe some of you have participated in. So good news for Broadcom shareholders there after the bell, with a double-digit dividend increase there coming your way. So all in all, looks like a pretty strong day for the markets. Let's get some of the details there with the breadth measures now. And we'll take a look here to see how many shares in the S&P 500 were up versus down. And it looks like that split today was 354 stocks up, 148 down. So that was good for about a 70% hit rate to the upside. So again, a very strong advance here today. Vast majority of stocks closing in the green. Let's now go ahead and pop on over here to our 4-grid. Remember, for those of you who are premium members of Market Scholars, you can follow along with David and I by looking at this pink label that you see in the charts that we display, and that will let you know which chart that you can pull up on your platform to kind of follow along with our analysis. So as you can see here, this is chart 4B, and this will allow us to see the market forecast technical indicator on all 4 of the major U.S. equity indices at the same time, so that way we can kind of more easily compare and contrast them. Now, the first thing that catches my eye when I pull up the 4-grid here today is that we are now back to weekly bearish postures on all 4 of these charts. Remember when I was with you 2 days ago on Tuesday, that was not yet the case. On that day, we had the Russell 2000 going to that bearish posture, but we still had the green background colors on the other 3 indices. So here we are a couple days later, and there's been enough of a continued sell-off where it's kind of pushed that green line on the market forecast out of the upper reversal zone on all 4 of these charts now. However, I wouldn't make too much of it at this point yet. Now, again, most of you are aware that we have our hesitations about where the markets will be in the coming year, and I've mentioned in the last 2 times I've done the presentation for you, how we've really struggled with that downward trend line on the S&P 500 at a key resistance area. So there are certainly reasons to be more pessimistic, but what I would say in this regard in the ultra short term is that the bulls haven't died, right? They're not dead. They haven't rolled over. They're still out there, and they're still willing to put up a fight if it is required. And today we did see a number of bounces. In fact, as I was going through trade ideas for the video here tonight, remember that's a key part of the time that I spend preparing for you guys for these presentations, I was kind of intentionally looking for a bearish trade setup, which I ultimately did find, and we'll talk about that a little bit later. And part of the reason I wanted to look for a bearish trade setup is because we did a bullish trade when I was with you on Tuesday with that sold put on Medtronic, which I noticed was up pretty nicely here today. So far, so good on that one. But I wanted to kind of offset that now that we've had a little bit more selling in the market lately. I want to start kind of refilling the bucket with some more bearish trades if at all possible. But one thing I noticed when I was going through chart after chart after chart, there were way more bullish setups than bearish setups. Now, part of that is just because what's going on here today where the markets were up. So naturally, when you look at something like the S&P 500 and you've had this pullback down towards the rising 30-day moving average, and today is the bounce day up and off of that moving average, then naturally a lot of stocks within the S&P 500 are going to look that way as well. But, I'm just going to throw that out there because who knows, maybe today was a day where I was kind of force fitting a bearish trade when my eyes were telling me there were actually a lot of bullish bounce setups that were taking place all over the place. So it's going to be interesting to see how that kind of resolves itself here in the coming days. Many of you know that we've got some pretty important data points coming out within the next week or so. Tomorrow we've got PPI. Early next week, I think on Tuesday, is CPI. And then on Wednesday, we've got the Federal Open Market Committee interest rate decision. So there's going to be some key data points that come out that can push this market one direction or another. But for our posture setting purposes, now that that green line on the market forecast has fallen out of the upper reversal zone on all 4 of those charts, we've gone to a weekly bearish posture. Keep in mind, if we do have a follow-up of several days in a row of upside activity, that can easily be pushed back into the bullish territory, especially since we're still above those rising moving averages in 4 of those charts cases. The only one that's the exception to that is the Russell 2000. Notice that the moving average color is yellow, whereas the moving average on the NASDAQ, on the S&P, and on the Dow Jones are all green there, telling us that price is above a rising moving average, and all else being equal, that's a more bullish feature of the market. So we've kind of got some work to do to figure out which direction the market is actually going to go. Right now, a longer term trend from the beginning of this year suggests that we have more likelihood to be bearish. But if you're looking at the trend just within the last couple of months, then you could get away with saying that, yes, this is still within the expected outcomes of retaining a bullish trend, bouncing up and off of the moving average, just like the S&P 500 did so back here on November 3rd. Notice that day we went to a weekly bearish posture as well. Even though we didn't really breach the moving average, we bounced up and off of it. And then as we started taking off, the moving average had to relent. I'm sorry, the posture had to relent and go back to a bullish posture. So could that happen again right here if we bounce, let's say, the next 3 or 4 days? Sure, especially since we've got some possible extremely volatile days coming up next week. So we'll keep our eye on it, but right now we've got kind of conflicting information from the market forecast perspective, a bit of bearishness, but from the moving average perspective, there's still hope there for the bulls. So that was the key takeaway for today. We now have a clean sweep of weekly bearish postures there with all 4 of these charts, but 3 of them remain with the price above rising 30-day moving averages. Let's take a look here at our 3 green arrows status as well. And so that will be chart 4D here for those of you following along at home. And in this case, we've got one chart with 3 red arrows, and that is the Russell 2000. All of the other 3 charts have a mix of green and red arrows. So for those of you that are not familiar with this particular chart and you hear us reference the 3 green arrows or 3 red arrows, what we're referring to are the 3 different technical indicators that you see on the charts themselves. Let me right click on the Russell 2000 so we can talk about this a little bit more and maximize that cell. And so that way you can see up above you have this 30-day moving average, which will generate either a red arrow or a green arrow. Down below, underneath it, you see this thing called the MACD histogram, which again will generate either a green arrow or a red arrow. And then down below that is a stochastic reading, which will generate either a green arrow or a red arrow. And if you hear us say that something has 3 red arrows, then naturally what that means is that with those 3 technical indicators, the most recent arrow is red. They don't have to happen on the same day. So this is actually a good example of that because 2 of these 3 red arrows happen on the same day. The MACD histogram and the stochastic, those both hit that red arrow on the same day on December 5th. However, it wasn't until the next day on the moving average up here that the 3rd red arrow joined in. So that's why on the background color of this chart, the pink background color didn't start until we completed the 3rd red arrow and did not start here on this candle because we only had 2 out of the 3 at that time. So when we have kind of a mixed bag where we've got mixed arrows, so in other words, a mix of green and red arrows together at the same time, then you're going to see that it's going to be a white or neutral background. And in the times when you have 3 green arrow signals, then that's where you're going to see the green background color, like back here in November On this day, we had this green arrow down below, this green arrow down below, joining this prior green arrow over here to complete that third green arrow. And then right here, where that green background color stops and goes white, that means that we lost one of those arrows. And in that case, it was the stochastic. So anyway, here you can see that we are in that 3 red arrows territory for the Russell 2000. However, if we go and look at the other indices, we are with neutral readings on the rest. The NASDAQ almost had it, and yesterday it did, but today you can see the NASDAQ got one of its arrows back. It was a red arrow on the moving average because the price closed below that 30-day moving average, but today we popped back above it and got that green arrow back. So right now we still have 2 red arrows on the NASDAQ, but we have 1 green arrow there on the moving average. And then here on the Dow, it's kind of the same thing where we've got 2 red arrows down below on the MACD, histogram, and stochastic, but we continue to retain this green arrow on the moving average that stretches all the way back here to mid-October. And again, that's another way to recognize that the Dow was our leader during this entire time period. The other indices had multiple red and green arrows hitting within their 30-day moving average along the way. But the Dow, once it got above its moving average back here in the middle of October, it stayed above it the entire time. It has not crossed back below there. So it has been the workhorse of this market here more recently. And then on the S&P 500, it's somewhat similar, although in the S&P 500's case, notice that they didn't get that green arrow there on the moving average until October 21st. So that was like a week after the Dow did. So the Dow did it earlier and has retained it just as long. Notice here the S&P 500 did cross below the moving average on an intraday basis on these 2 candles, but it didn't close below there. So that's why you don't see a red arrow showing up during that time period right there. Remember, the Dow didn't really do that, I don't think. Let me just check again. Yeah, the Dow, when it pulled back during that time period, didn't even come close to sniffing the 30-day moving average. So another way to interpret that the Dow has been the workhorse of this market. But as you look at this S&P 500, as I mentioned before, this isn't a half bad looking bounce attempt that we are staring at right here. Remember, this has been 5 days in a row prior to today that we had selling behavior in the S&P 500. 1, 2, 3, 4, 5, where the close of the day was lower than the previous day's close. And we've had maybe 3 or 4 instances of 5-day sell-offs this year. So we oftentimes don't get that because it's pretty rare. But this year has been a year that's been filled with a lot more selling than normal as well. So it's been a little bit more common this year. But the good news is because we were up so far above the moving average, even a 5-day pullback, all it did was it brought us back to the moving average where theoretically it could set up for a bullish bounce here. You'll also notice that this bounce pattern is kind of giving you the impression of a close above the high of the low day. It might not be perfect because that one might have been the low day right there, but usually you're kind of looking at where did that downtrend stall out, and that would have been in this candle here yesterday. So that close above the high of yesterday at least is in play at this moment in time. Notice that today's close was at 39.63. And yesterday's high was 39.57. So we closed about 6 points above yesterday's high. And a lot of people like to play those bounces with the expectation that this mini flush out in the market has kind of resolved itself, and now the bulls get to take it and advance the ball for a few days to the upside. So we'll keep our eyes on that if that's a possibility there. But I just wanted to point that out because we've seen that type of behavior before, and it can lead to at least some short-term trades that can work out for you. All right, let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these market outlook presentations on the various social media channels that we have out there. The one that I pay the most attention to is Twitter. I don't really hang out on Facebook at all, and I don't really go over to LinkedIn a whole lot either these days. So the area that I find that I'm sharing the most information is on Twitter, and that's why it's a little bit easier for me to track the progress and success or lack thereof of our efforts to try to get some of this information out to our populations out there. And you guys didn't let me down last time, so thank you very much. 115 of you clicked like for me when I did the video on Tuesday, so it made it easy today to get out there and look for a trade opportunity and make sure we get a full-length video done for you here today. So thank you to each and every one of you 115 out there. Let's go ahead and do some shout-outs here. Thank you to Ron and Brandon and Norma Jean and Dave and T-Fib, Jeff and Stacy and George and Dennis and Lucius and Arth and James and Ali and Marita and Ox and Ram and Jamie and Sonia and Violina, HR, Tom, DGI and Options Daily, Sarah, Ayakipa, Doug, Victoria, and others. Too many to go through. We don't want to soak up too much time, but I always want to acknowledge you, and I do appreciate each and every one of you taking the 5 seconds out of your day to do that. As is always the case, I will make the same offer for you. If you're willing to get me up and over 100 likes there on Twitter, I'll be more than happy to do a full-length video for you, including a trade application example the next time I'm scheduled to do the video, which will be next Tuesday. For whatever reason, I'm not sure why this is exactly, but I've found that it's been easier for you guys to get to 100 likes when I do the Tuesday video by the time I'm scheduled to do the video again on Thursday. So in other words, there's only 2 days in between there. And I found that that's been more consistent than the other time when I do the videos on Thursdays. It's a little bit more like pulling teeth to get 100 likes by the time I do the video again the next Tuesday, which is weird because there's more days for the likes to accumulate. So I'm not sure what accounts for that exactly, but nonetheless, if you get a chance, just stay in that habit and help David and I out there. It's our incentive of doing these videos to help get our word out about our organization. So thank you for being willing to do that. It means a lot to us. All right, let's go ahead and also remind you that what we tackled today in our premium classes, Dave went and did his ETFs class, his portfolio management with ETFs class, and then I did my question and answer session. And some of the questions I tackled here today would be a question about dividend growth investing and how to think about rotating stocks in and out of the portfolio, if that's a possibility. Which types of stocks within our portfolio that we once wanted in our portfolio would we be willing to part ways with in order to free up capital in order to buy new opportunities that are showing up on our doorstep. I also got a question about Owens Corning. That's not the fiber optics company. That's instead the insulation company and home building products company. And they've had a really nice 2-year stretch of dividend growth. In fact, they've doubled their dividend in just 2 years. So we took a look at that along with a lot of other metrics for that business in class earlier today. We also got a question about that chart 2A, otherwise known as the dividend stair-step chart, which you guys oftentimes see me posting screenshots of and things like that on Twitter. Of course, that is the driving chart of what we do in my dividend growth investing classes. And just a friendly reminder, like I mentioned to the students in class today, remember that particular chart needs to be updated every single year. And the reason for that is because of the calculations that go into the average high yield and average low yield numbers is on a rolling 10-year basis, and that is not happening automatically within the Thinkorswim platform. It's happening outside of the platform on my spreadsheets, which I then have to go and build back into the charts once per year. So early next year, with hopefully within about a month or so from right now, I'll be in that process. So stay tuned on that. I'll try my best to let all of you who are premium members know that the new calculations are ready to be imported into your own Thinkorswim platform. Speaking of which, I saw the news headline on Twitter today that TD Ameritrade is now going to be formally absorbed by Schwab. Now, of course, we've known about the buyout for years. It's already kind of happened. Remember, TD Ameritrade used to be a publicly traded company. It no longer is. So technically, it's already part of Schwab, but they've kind of left the user experience separated along the way here in the last couple of years. But word did break earlier today that TD Ameritrade will no longer be a thing. And starting next year, at various phases throughout the year, TD Ameritrade clients and accounts will be fully absorbed by Schwab and will be rebranded by Schwab. And it sounds like you're probably going to have to come up with new usernames and logins and things like that as well. So what I'm wondering is how that's going to affect our various logins that we use for our class accounts. So I'm going to have to get some more information on that as we head into next year. But I just thought I would remind folks of that, because I know many of you probably are TD Ameritrade users. That's how you knew David and I in the first place, since we both used to work over there. So that will be a pretty big change for a lot of us as we head into next year and become official clients of Schwab and no longer TD Ameritrade. But anyway, I had a good conversation here about how to think through the idea of calculating the average high yield and what the theory was originally when I came up with this idea, and how it was imparted upon me from some other firms out there, and then how I've taken a slightly different spin upon that and why I've made those decisions. And so if you have any interest in that topic and you're a premium member, feel free to check out that conversation at the 1 hour and 48-minute mark. And then we had a question about Fidelity National, an F&G spinoff that took place here recently, and we did some analysis on whether that would still make a good dividend growth investment. We actually talked about blockchain as a part of that conversation as one of the potential disruptors to the title insurance industry in the future, and also talked a lot about the current state of the home building market and what that means for the future with mortgage rates as high as they are, and of course affordability not doing us any favors with sky-high home prices. So anyway, if you have any interest in those topics and you're a premium member of Market Scholars, feel free and check out that recording. It is now posted to our website. Let's also take a look here at our factor selector tool. A reminder that the factor selector comes out on Tuesday evenings, and so it's a couple of days stale by the time we get here into the presentation on Thursday. I build this for my Wednesday morning swing trading class. And some of you might have heard the comment that I made on Tuesday in this very presentation, where I said that my hunch will be that value will fall from a factor perspective when I put the factor selector together within the next 24 hours of me having stated that. And my reasoning behind that was because of the big drop that we saw out of financials and energy. And financials and energy, from a sector perspective, are a huge portion of the value factor itself. So no surprise, that did end up coming to fruition just as my gut was telling me in that case. You can see value did drop 2 slots week over week from number 2 down to number 4. We do have low volatility making its way all the way up to the top slot, and that's the first time low volatility has been number 1 since going back here to late September. A couple things going on with that. First of all, remember, before today, we were in the midst of a 5-day sell-off, and so markets tend to drift towards what they perceive to be more defensive securities when market prices are more choppy and kind of a risk-off market environment. So I think that helped that, because remember, the low volatility factor is going to contain lots of utilities, REITs, staples, healthcare companies. And so with the big market sell-off here in the last 5 days, naturally, those types of securities are going to be a little bit more appealing than the really cyclical other kind of exciting areas of the market. And then the other thing that I mentioned to my factor-based swing trading class yesterday morning that was unique this week was something that I had also mentioned here on Tuesday night to those of you that watched this video, where we were doing our 12 grid analysis, and I was mentioning how rare it was for the S&P 500 to be in the midst of, at that time, it was a 4-day losing streak. And at the same time, we had interest rates falling 3 out of those 4 days. And how odd that was, because for most of 2022, that simply was not the case. Usually, what had happened is if interest rates were rising, then the S&P 500 would fall, but if interest rates were falling, then the S&P 500 would go up. So this was a little bit of a reversal in that traditional relationship that I pointed out to you guys on Tuesday night, and I think that had a little bit of an impact here on the low volatility factor as well, because of what I mentioned here just a moment ago, that utilities and REITs make up a pretty big portion of the low volatility factor. Remember, utilities and REITs are the most interest rate sensitive sectors that are out there. So not only did the low volatility stocks benefit from their defensive characteristics in the middle of a market sell-off, but you didn't have the offsetting negativity around the interest rates, basically kind of balancing that out like had been the case earlier this year. Interest rates stayed low while the stock market went down. Both of those things tend to benefit utilities and REITs on a comparative basis. So I think that kind of tells the story as to why low volatility was able to have some relative outperformance here more recently. And then those low size stocks are still stuck at the bottom of the graphic there. All right, let's go ahead and take a look at some 12 grid analysis now. Back over here to the Thinkorswim platform. And let's take a peek here at chart 5A. This is our asset class 12 grid. And as has been the case for much of this year, I like to drift my eyes initially to the two lower corners, and the reason for that is they have largely been driving price behavior in the stock market. But as I just mentioned a moment ago, that's what made this last little run so strange. Treasury yields continued to slip over the last week at the same time the S&P 500 was falling over the last week, and usually that had been the opposite of one another. So today we did see Treasury yields snap back a little bit here. Wasn't a huge amount by any means, but still a little bit of levity there in interest rates. We did close at 3.49% on the 10-year Treasury yield. Remember, the short-term yields are still a lot higher. I've been doing a lot of those 3-month bill auctions on the TD Ameritrade website for the last, I think, 5 weeks now. And each week when I participate in those auctions, I'm getting well in excess of 4% yields on 3-month Treasury bills. So that's what's made this market so peculiar, is that the shorter term your duration, the more you're getting paid. And remember, that's usually the opposite as well. Normal functioning markets, it is the opposite, where you get paid less money for the government to hold your money in the short term, and you get paid more for the long term. That's the way that the normal laws of financial physics should work. But that's the opposite of what we're dealing with right now because of the whole inverted yield curve conversation that's taking place. So short-term rates are actually holding up at high levels still, and they really haven't budged hardly at all in the last few weeks. At the same time, long-term rates have gone almost straight down. That's a very aggressive move lower there on the 10-year Treasury yield. Like I was mentioning on Tuesday, we had gotten up to about 4.33% on the high, and we've already slipped all the way down to 3.5% in just a couple of months right there. That's a very aggressive move in such a short amount of time right there. So remember, when interest rates are up like they were today, then bonds typically are down. And you did find that to be the case here, at least with the long-term U.S. Treasuries down 0.27%, and then foreign bonds were down 0.36%. However, if you look at it from a kind of a broader perspective, we remain in an uptrend with both of those bond categories, and we remain in a downtrend with yields themselves. So this was kind of one of those one-day reprieves, and we'll see where it takes us. Obviously, we're going to find out a lot more about that situation early next week when we get an FOMC interest rate decision on Wednesday. Notice that the US dollar did slip here today. That's kind of been the house of pain ever since topping out back here in late September. Remember, that topped out a lot sooner than a lot of other things, like the Treasury yields, as an example, didn't top out until the end of October. The dollar was already topping out back here at the end of September, and it never was able to regain those prior highs, and we really started breaking down. And of course, you know, we were here relaying that information to you all along the way, so none of you should be surprised by that if you were listening to us along the way, because we were basically looking at it day after day after day and saying how aggressive this move was, and that there was a legitimate chance of a true trend reversal here. It wasn't just a gentle drift down towards a moving average and then bounce off of it. It was an aggressive rip through the moving average, which meant that it meant business, right? It was serious about the move. And now you can see here we are 3 months later, and we're basically plumbing new lows on a 3-month basis on the US dollar. So if If you were going on your international vacations, hopefully you were doing it back here in September, where that US dollar would have gotten you a lot more buying power than it will here today. But keep in mind, when the dollar is struggling, that's a good thing for your stock portfolios, all else being equal. So it's no surprise that during this time, when the dollar is falling, the U.S. stock market and foreign stock markets were all rallying pretty furiously. So, what you're losing in purchasing power on your overseas vacations, hopefully you're gaining back in your brokerage balances at the same time. Notice that gold was up yet again. So the dollar being down means that more times than not, gold is up. And that's another inverse relationship most of you should be aware of. It's no surprise that gold has had this really nice injection to the upside. At the same time, the dollar has been slumping lower. And so, like I mentioned to you guys either last time around or last week, I can't remember when I said it, but I had mentioned that gold to me seems like the type of situation where you could have a legitimate reversal taking place. And the reason is because of how aggressive the move was off of the lows. So like if I were to maximize this chart and let's take it back, let's say like on a 1-year basis, gold was in a house of pain for many months in a row. It topped out over here in March of this past year, March 8th. And after topping out that day, it was just a house of pain all the way until hitting this low. Actually, the low was right here on November 3rd. The last 1 month has been such an aggressive snapback that it leads you to believe that they're serious. This time is different, right? Because when you see these other snapback rallies that took place along the way, it ended in a whimper, right? You got back to the moving average, you rolled over. You got back to the moving average, you rolled over. You got back to the moving average, you rolled over. This time you got up to the moving average and you just burst through it in a big way. And even when you had a kind of a response move like that, it didn't even come close to touching that moving average, which gives you a sense that it's much more resilient this time around, and it's going to potentially have some legs from this level. And I think it kind of fits the narrative of what I'm thinking in my head as well, in terms of next year being a difficult year for stock traders. But in an environment like that, it is possible for alternative investments like gold to do better on a relative basis, and even having bonds do better next year than what they did this year. Remember, bonds doing so poorly this year was a real surprise. Not that we didn't think that bonds could do poorly, because obviously we were at historically low interest rates, and that can't last forever. But the strange part about it was how bonds and stocks did poorly at the same time, and rarely throughout history has that ever happened to that degree. So next year would not surprise me at all if we had a year where gold and bonds did well together, and stocks still continue to struggle to kind of work out the excess out of the system. We shall see. Remember, every day gives us an opportunity to absorb new information, to read the charts a little bit more better than the previous days. And so all that kind of stuff can change. But in general, I'm kind of interested in gold at this level as a trade. I don't think as a buy and hold long-term investment it does you too many favors. But from a trading perspective, it would not surprise me in the least if we woke up a year from right now and we saw that gold did relatively outperform stocks in this upcoming year that we have in front of us. All right, let's go ahead and get back to our main view here. Bitcoin was up today. It was up 2%, but it still remains kind of just stuck down there at around 17,000. You can see it's still below a falling moving average, even though it's got a weekly bullish posture at this point. Oil is quite the story here lately. Oil just keeps on, ticking lower, back and forth and back and forth. Remember, earlier this year, oil was doing so well, and we've given up so much of those gains. Let me right-click on oil, maximize this chart, and let's go back to a 1-year chart on this as well. And you can see that this was a red-hot investment for the first half of the year. Here's the start of the year where I'm kind of circling with my mouse over here, and here is basically the middle of the year. This is June. So for the first half of this calendar year, this is one of the best investments out there. Since that topping out point, it's become maybe one of the worst. So you have almost this this tent effect, right? A camping tent where you've got that peak in the middle right there, but you had this big run up followed by this big run back down. Now, you haven't given back all the gains yet, at least on USO. Let's check the futures contracts on this as well. For that on Thinkorswim, you just use /CL. So you have to use the forward slash in there. Remember, if you don't use the forward slash, you're going to pull up Colgate. Sometimes people do that. CL is Colgate-Palmolive, one of those dividend aristocrats I like. But /CL is going to be your crude light, is what that CL stands for. Some of you might refer to it as light sweet crude. And you can see in this case with the futures contracts, you are actually down below where you started the year. So USO does not track it perfectly. USO is still up just a smidge on a year-to-date basis as an ETF or an ETN that tracks it. But if you're actually trading the oil futures contracts themselves, they in many cases are actually lower on a year-to-date basis. And who would have guessed that back in June when it was one of the strongest trades out there and everybody was talking about Russia, Ukraine, and all of the seizing up of energy assets out there. It's a little bit surprising to say the least, but that's why they play the game, right? You never know who's going to win. You got to let them play it out. And right now, markets are saying, you know what? We still have plenty of oil out there, and there's still not enough demand, or at least if we're heading into a recession in many parts of the world, there's expectations of less demand of oil usage moving forward. So it's kind of interesting. Notice that we do have some oversold cluster signals showing up here on crude oil futures contracts. And so perhaps we're due for a little bit of a bounce. Notice that we got this other cluster back here on the 25th of November as an example, and that was followed by a pretty strong 4-day rally after that. We had a really big rally after these clusters over here as well. You had another big rally after these clusters. You had another big rally after these clusters, another big rally after these clusters. So you can see that crude oil seems to respond pretty good to those clusters there, which now makes me start to second guess the trade application I'm going to bring to your attention because it's a bearish oil stock. Now, one thing I will say about oil stocks versus oil itself is that oil stocks have actually held up pretty well considering what we're looking at right here with the commodity of oil. The commodity of oil has done horribly, but oil stocks have actually retained their value much, much better. Part of that is because they're much more profitable now than they were in the past. And so it's not just a matter of what direction oil is heading, it's how much profits can be made when you are basically digging oil out of the ground and converting it into gasoline and then selling it to the end consumer. So there's a little bit more complications in it from that perspective. It's not quite as simple as just looking at the commodity. Nonetheless, it is obviously the case that oil stocks tend to follow oil. And in this current moment in time, it seems like there's been a little bit of a lag there where, you guys have heard me use the term wobbly when I've described the oil stocks here over the last couple of weeks. And they've been kind of hanging out up there towards the top. So here is XLE to give you a sense of that. Where XLE is still up here. Yes, there's kind of an interesting double top formation for oil stocks here from June to where we were at here in November. But you'll notice XLE is still up 48% over the last year. That's what this little tag off to the right-hand side means. So it's up 48%. That's the typical energy stock in the S&P 500 is the way that you can kind of think about that. And then kind of going back over here to crude oil futures contracts to compare that. And year over year, it's only up 2%. Now remember, this is a 1-year look back. So when I had mentioned before that it was down this year, that's because, for these 4 weeks over here, that was the end of 2021. So the start of 2022 is right here. And it is down a little bit on a year-to-date basis. But on a full rolling year basis, it's up 2%. But still, you get the point that I'm making. The typical oil stock is up 48%. Oil prices themselves are only up 2% over that exact same time period. So that's a very bizarre kind of anomaly that we're dealing with here. And the longer that oil prices stay low, the more that you'd have to believe that eventually oil stocks will start rolling over alongside of that. But, obviously nothing is guaranteed, so we want to keep our eye on it. But that is one thing that I think we should all be on the lookout for moving forward. So anyway, another tough day there for oil, down 1.5%. Let's go back to our main view here now and talk through some of these other charts up here at the top now. It wasn't just the United States that was up today. The international markets were outperforming U.S. markets. And remember, that has been a common theme here recently. I've been bringing that up regularly with you guys, that EFA was at a 6-month relative strength high versus the U.S. markets. EFA tracks the developed foreign stocks, so think Europe, Australia, Japan there. And oftentimes they have an added advantage if the U.S. dollar is weak, and that's the exact environment we happen to be operating in right now. The U.S. dollar has been a lousy place to be for the last, let's call it 2.5 months. The reverse of that is foreign stocks have been a great place to be for the last 2.5 months. And once again, EFA outperformed, or at least performed kind of admirably here today at 0.51%. EEM actually did outperform the U.S. markets today, up 1.21%. And EEM, of course, is where you're going to find China, India, Russia, Brazil, that sort of thing. Not so much Russia these days, as a matter of fact, because a lot of the Russian financial assets were seized up as a result of the reaction to the Russia-Ukraine war situation. But traditionally, Russia would have been included with the emerging markets. But these days, China is the biggest driver within that batch. And as we've been talking about here recently, China has been red hot, right? It's not just a passing fad. You look at something like FXI, look at that move off the lows here at the end of October. That is straight up. I showed you guys KWEB here recently as well. KWEB is straight up from those lows in October. In fact, KWEB is at multi-month highs right now. That tracks the internet companies in China. And then if you look at just an individual internet company in China like Alibaba, this stock was left for dead not too long ago, and it's just moved 40% off of its lows just in a couple of months' time there. So, that's been really interesting to witness. And part of that is probably the fact that the U.S. dollar is weak during that time period. The other part, of course, is there's a lot of news coming out of China with, COVID and hopefully getting that economy back on track and things like that there as well. Anyway, good day there for EEM, up 1.21%. Both the developed foreign stocks and emerging foreign stocks were, in that strongly bullish posture perspective, and both have those rising moving averages as well. So wouldn't surprise me at all if we start seeing a lot of foreign individual stocks with strong trends out there. Let's now take a look at the sectors, and for that it'll be chart 5C. And as you can see, a little bit of a mixed bag here at the moment, and that had not traditionally been the case. A week ago, you'll recall that energy was the only pink chart on the board. Maybe that was giving us a heads up that energy was about to start suffering some selling. Fast forward to Tuesday when I was with you, energy was joined by consumer discretionary, at least on a market cap weighted basis. And then fast forward here 2 more days today, and now we've got a whole bunch more pink charts showing up. We've got the S&P 500 itself, we've got financials, we've got communications, we've got technology, and we've got real estate all in that particular category. So that leaves us just 5 green charts left on the board. We've got industrials, materials, healthcare, staples, and utilities retaining their strongly bullish postures. Of those, I would say that healthcare probably looks the strongest to my eye. We've had a really nice 2-day rally here in healthcare, and we're right about to break into 3-month high territory once again if we can get another update here as soon as tomorrow. These others have a little bit of work to do. You can see that industrials is quite a ways away from where it was a week ago. Same thing goes for materials. Staples is a little bit closer to its highs, but it does look like it's probably going to be healthcare that will lead the way here moving forward. So let's keep our eye on that possibility there as well. And then again, the laggard at this moment in time is clearly energy. It's the one with the dark pink background color telling us that we've got a strongly bearish posture on it. And even on a day like today where the rest of the market finally bounced back after a 5-day losing streak, energy still closed in the red once again. So this is now the 6th day in a row of selling for the energy sector specifically. It was down 0.45%. In fact, it was the only sector, I take that back, one of only 2 sectors that closed lower here today. Communications did as well, but only by 0.2%. So energy was the worst performing sector today. Let's see who the best was. It might have been technology. Yeah, it was. Technology was up 1.64% today. Remember, we were looking at that heat map, and all those semiconductor companies like NVIDIA were up so nicely alongside Apple and Microsoft and others. So today was a good day for tech to snap back there, but they still retain their weekly bearish posture despite the one-day bounce. That's a pretty nice looking bounce up and off of that moving average right there, though. So who knows, maybe we can get a little bit of upside action from that. So let's go ahead and now talk about our trade application example for tonight's video. And as I've already alluded to a couple of times, it's going to be in the energy patch. And again, here's what energy in general looks like right now. It's looking a little bit sketchier each and every day that moves along. And so I wanted to kind of focus on a more bearish type of an energy setup, knowing how this sector is kind of starting to sputter here more recently. So let me go ahead and get my chart 3A out here, and I'm going to pull up ticker symbol APA. This is the old Apache Corp. And as you can see, I've got this blue line drawn on the chart here, and that represents where my break even is on this trade that I did. So what I did, and remember, those of you that are premium members, I always get these trades done while the stock market is open and then send you out all the details on that, so that way you can consider the trades for yourself if you so desire. That's a nice perk that we offer to you premium members as opposed to all the folks that watch just the free YouTube video at night. So I did the trade already. The trade that I did was selling a January 47.50 $50 bear call spread. So for those of you that are not as familiar with options trading, effectively what I did was I sold the 47.50 call. And many of you are familiar with like covered calls, and you understand the concept that when you sell a call, that's actually a bearish thing. So that part of my trade was indeed bearish, and that will be the driver of my trade by selling the 47.50. But at the same time, I also bought a $50 call, and so I had to pay a little bit of money for that. And that is not the driver of my trade. When you are selling a lower price call and buying a higher price call, in this instance, it's creating what's known as a credit spread. So I received a credit up front in my account for my willingness to take on this trade. And the reason I bought the $50 call as part of that trade is because that acts as my embedded hedge within the trade. And so what that means is if for some reason Apache gets a buyout offer tomorrow morning and the stock just skyrockets, 50% or something like that, anything over $50 per share I'm covered with. That's the point of that. If I didn't have the bought $50 strike with it and I had just only sold the 47.50 call all by itself, that's known as selling a naked call, then I can be in real big trouble if there's a buyout announcement that is made. So it's a way to kind of mitigate your risk to a degree without having to use a stop loss. It's kind of, you can almost think of it as it itself is a stop loss embedded within the trade. So, but what I still want is for this stock to stay below my break-even price. And I think it was 57 cents for selling that spread. So if I add 57 cents back to 47.50, that comes up with this number 48.07, which is basically where my break even is. As long as this stock stays below that blue line through the January expiration in the middle of January, then I should make money on this trade. It is a bearish trade. On the other hand, if this stock turns around and starts going above that blue line, then my trade gets into trouble, and I've got to manage it or do whatever I need to kind of unwind that situation. So I wanted to kind of sprinkle in one of the first bearish energy trades that I've done in quite some time to take advantage of obviously this bearish posture we see on this chart. You can see that the Moving average has now been converted to red as well. But mostly it's kind of a play on just the fact that energy stocks in general have been so wobbly lately, and I want to see if I can kind of play into that theme. You'll also notice we have a little bit of a bearish near-term divergence where you've got a peak in the near-term line down here followed by a lower peak right here, and on those two candles up above, it's this one and this one, and on a closing price basis, you have a slight upward ascent there. At the same time, you get a slight downward ascent on the underlying indicator in that case. So maybe that helps the cause a little bit there as well. Okay, so that's what I had for you here tonight. I hope you enjoyed the presentation. Hopefully you learned a thing or two, or at least you feel more equipped to tackle the next day and understand some of the movements within the market here more recently. Remember, we've got the PPI announcement tomorrow that could cause a little bit of volatility, but hopefully it's not too dramatic as we head into the weekend. The real news will come out next week, so stay tuned on that. But if you got value out of tonight's video, do me a favor and click like for me there on Twitter. As long as we're up and over 100 likes by the time I'm scheduled to do the video again on Tuesday, I'll plan on giving you another full-length video like this one, including a trade application example. On the other hand, if you prefer the shorter videos and only want me to go 15 minutes without a trade application example, then don't click like for me on Twitter. And if we're under 100 likes, then I'll just plan on doing an abbreviated one on that day. David should be back with you tomorrow as well, so look forward to that. And for the rest of you, I want to thank you for checking out the video tonight and wish you well for the upcoming weekend. Take care, everybody. Bye-bye.